Good morning, everyone. So what I'll do here is I'll just run through our most recent announcement in the form of a presentation, and perhaps when I'm finished, just for efficiency, we'll open up to questions. As Tony's explained, there's plenty of people in the room that can handle your questions, and our CFO, James Deo, is in the front row. So feel free to ask away. Do you want to kick off, James? So the necessary disclosure statements. As everyone in the room is very familiar with Asiamet, I won't labour too much on this point, other than to say we've got a very established and large portfolio of assets focused on Indonesia in the copper gold space. We feel, and through this presentation you'll see, we feel it's still a very compelling value argument, and I think corporately, and as Tony's alluded to, it's a deeply experienced team that's worked very much at the big end of town, but also at the small end of town. So we sort of understand how to find, develop and operate these sorts of projects. Next slide, please, James. Quick snapshot of titles of the company, just on 1 million shares on issue, capped at just a little less than that today, but circa £50 million, with an enterprise value of 46 to 47 million. Everyone's aware of the share register. It's a very strong retail support register, but also sitting on that register are some very solid names. JP Morgan, Asiamet, Namarong and the board. Just reminding everyone who are not aware, both Asiamet and Namarong, who are based out of Australia, have co-invested in a number of things that Tony's been involved with before successfully, so they've been very long-term, very supportive, and very strong investors. And by all means, when we're done, collar Tony to talk about that in a bit more detail if you wish. Next slide, please, Tony. We talk about this a lot, but I think it's worth reiterating the copper thematic. Why are we in copper? In short, it's a 22 to 23 million tonne consumption market per annum, and it's been growing consistently since the 1950s. With base level consumption, that's excluding things like, the new sexy things like renewables and the like. So it's a very strong market. But the issue that's approaching the market in the short and medium term is the fact that over the past probably 10 years, there's been very little in the way of reinvestment in the sector. And these projects, copper projects, take a long time to bring online. You can't bring them online in 12 months. Some of them are 10 and 15 year lead time. So they take a long time. So that's what you're seeing in the left-hand chart there. You see that the red line is what we expect to happen with copper supply from about now. It's going to slide off unless it's replaced. The chart on the right-hand side in the red circle is an illustration of the capital required to keep that line steadily going up. So currently there's about $44 billion committed to developing new or expanding projects in the copper sector. There is a requirement for $188 billion to be invested in the sector. So there's a gap of $104 billion. So I'll just leave you with that thought. There's just not enough development going on in the sector. So our expectation with respect to the sector is very positive. And we remain very enthused about the copper sector. Next slide. Well, that's an interesting slide. It's a bit washed out. You might have to look on the side screens there. This, for some reason, the screens blacked it out. But just reminding everyone where our assets are. We're in Central Kalimantan. That's the KSK project. We've just completed a feasibility study on, which we own 100%. And then to the northwest of that is the much larger Butong project in northwestern Sumatra, which we have an 80% interest. The other point I want to leave you with here is that from a permits and approvals point of view, we're very systematically moving through that and have very good tenure with respect to both projects. So I'll touch on all the other issues a little later as we move through. Next slide, please, Charles. The Friday before last, we released the outputs of the feasibility study for the BKM project in Central Kalimantan, which we've been working on for a little over 12 months. So a quick snapshot of that, up to 25,000 tonnes of copper cathode per annum over a 9-year mine life, for an NPV, base NPV of 125 million and initial capex of 220, generating revenue of just under $1.3 billion and an EBITDA of 560 million. The bottom two tiles are very interesting. From a so I'm not sure if everyone's aware what capital intensity is. Capital intensity is the amount of capital spent compared with your base level production rate, in our case 25,000 tonnes per annum. And we've got a published number there of $7,680 per tonne. And if you add the contingency for the project, it's $9,200. So what does that mean? A lot of new projects coming online in the copper space right now and more recently, that capital intensity number is much higher at an average of about $15,000 a tonne. So we're very competitive with respect to that. And the reason for those other ones being up at that level is a lot of the projects are underground, they're going deeper, and the grade overall for new copper projects coming online is falling. So we're reasonably competitive in that regard. From a cash cost, which is a C1 cost point of view and an all-in sustaining cost point of view, for an SXEW project of this size, it's a good project. It sits about in the middle of the range. So it's not the best cash cost, but it's certainly not the worst. So it's a very competitive number. We've talked about this a bit before, but the logistics for the project are very good. We'll utilise the very large shipping port of Banjarmasin for inward and outward goods and truck materials in and out of the site, which is about a 5.5-hour drive from the capital city of Blankaraya by an already established road. Next slide, please, John. What this slide is just showing is the general layout of the site. So it's a relatively, even though it's only about 400 vertical metres above sea level, the project is quite mountainous. And we have about 3.5 metres of annual rainfall per annum. There's a wet season and a dry season, but to be honest, it rains all the time. So it's just sort of, it's wet. I think John is probably the way to describe it. But at a high level, a relatively simple mining operation where in the centre there we have an open pit mine. We have a processing facility in the centre, heap leach operations, and then waste rock dump over to the western side. And relatively compact, as you can see from the scale bar down on the bottom left. Next slide, please, James. From a treatment point of view, the point we've been making here is that it's all of the kit used from sort of cradle to grave in this project is off the shelf standard sort of kit. So we're not using a fancy untested new technology. An SXEW route is a very well used, well understood route, and from that point of view, there's no long lead time items. It's readily available, and one of the capital numbers that we've released to date is making the assumption that we use all brand new kit, no second-hand kit. But we like to remind people that there is the option of considering good quality second-hand equipment in the flow sheet. So that's something we'll certainly pursue in the detailed engineering phase. Next slide, James. So the next few tiles are just having a look at some of the key metrics out of the feasibility study, and then if there's questions at the end, please jump in. So the top slide there, what we want to illustrate is the ratio of ore to waste. So waste to ore, the strip ratio at the start of the mine is relatively low, which is that black line. So in the first 4 to 5 years, the strip ratio is effectively 1-to-1, so very low, very competitive. And at the same time, we're focusing or honing in on the higher grade copper ore material, which is the second chart. So you can see that the grade in the early period is high, and then and then tails off. So from a value generating perspective, you want to do that. You want to bring forward your highest value material forward to the earliest possible period. And clearly, from a cash flow point of view, it brings your cash flow forward. Next slide, please, John. So how does that look from a production perspective? In the top tile, you can see that we start to max out reasonably quickly to our 25,000 tonnes per annum production level for sort of 4 to 5 year period. and then it tails off. So what we would expect would happen as we get moving into this project is that there's quite a bit of inferred, so if you like, lower confidence material that exists within the immediate mine area, which by definition in a feasibility study you can't include in your mine plan. It's excluded because it either doesn't have enough drill holes in it or you need a bit more data. So our expectation would be at the back from 2027 onwards, there's a reasonable probability we can fill up that production profile, and that's not an unusual thing for mining companies to do. So in your mining process, you will always continue to look for more material. And the other reason you do it that way is that we don't want to be drilling holes today or spending money today for material that we're not going to consider to bring online for 4 or 5 years' time. It doesn't make sense. But clearly from a value perspective in the project, what you're looking to do is increase your value as you get moving. So a feasibility study is not the end of the story, it's really the start of the story. Then in the bottom chart, what you're looking at is a typical cash flow chart where you can see both in the blue, the net revenues, in the orange or magenta, the operating costs, and the cumulative cash flows in black. Next slide, please. This is just a breakdown of the capital estimate that we've undertaken in the feasibility study. I just wanted to point out a couple of things. So the first thing is that we've done this with independent advisors, and it's by definition reasonably conservative, so we feel that there's some room for improvement here, but having said that, it's a good base set of numbers. But I'll give you a couple of examples where we think we could possibly improve over time. If you look at, I'll just pick on a couple of numbers, on-site infrastructure and bulk earthworks, the assumption made there currently is that the bulk earthworks for the development of the processing facilities, camp, infrastructure and that sort of thing is done by a civil contractor, civil engineering contractor, and the mining is done by a mining contractor. There is a big opportunity there to replace the civil piece with the mining contractor because their earth moving rate is half the rate of the civil contractor. But for the purpose of this exercise, that's what we've done. Also, we feel that from a project engineering point of view, $10 million is a reasonably large number. Clearly, the advisors we used have an interest in having this as big a number as possible because they're first cab off the rank to potentially get that job. But for a project of this size, you may consider managing that internally at a much lower level. So they're just a couple of examples. And if you look at the contingency number, there's also room to improve there, but that's something we'll address as we move forward. Next slide, please. So one of the things we also asked the engineering team to consider as part of the feasibility study is you need to put together a very strong base level study, but you also need to understand what's the pathway moving forward through detailed engineering, funding and development. Are there other things that you can do as part of that process? And as part of that exercise, we got them to consider what are the value enhancement steps we can address from here that can improve upon the base study. So as we can see here, there's base NPV valuation of 125 million. But in addition to that, on a risk-weighted basis, we think there's quite an important list of things that we need to address that could potentially add another minimum 35 million to that base case number. So that's that centre bar there. So taking the valuation up over 160 million if we can achieve those steps. So that's something we are pretty keen to address in the next 2 to 4 months before moving to the detailed engineering phase, because any of those steps, clearly you want to fold them into your detailed design prior to the commitment for development. And of course, the one thing that you can't consider in a feasibility because it continues to change and improve is your exploration. Can you add more? Can you add more tonnage in addition to what you already have to your production profile as you move ahead? So clearly around this project, there's a lot of exploration potential which we need to consider systematically as we move ahead, which I'll address in the next slide. Okay, so many of you have seen this slide before, but I just want to drill down on it a bit more. Within the contract of work, where we have very strong tenure, there are 15 quite specific targets in addition to BKM, which we're currently working on. Now, clearly, as a company of our size, one of the objectives that Tony was pretty strong on early in the piece is that you've got fantastic mineral endowment, right? So there's lots of things to address, but you can't address all of them at once. You've got to be very systematic about it, run each argument down, evaluate each argument, and then when you've done that, move forward. Otherwise, you could be drilling there literally for the next 40 or 50 years, but never actually closing out or addressing an issue specifically. So the one that came up first that needed addressing was BKM. And of course, we've now taken that through to feasibility. But there are 15 others which will need to be systematically addressed. Of those 15, there are 4, which we talk about on this slide here, that sit immediately adjacent to BKM. So from a priority point of view, what makes sense for us is that as we move forward towards the detailed engineering, we would hope to get on those 4 or some of those 4 in that period to evaluate whether or not we can add to the resource base, which will then add to the exploitable copper tonnage base once you build a project there. So very important point. I mean, we would see that what we've currently published is a bit of a base case which we can build upon. Next slide, please, James. This slide's an interesting slide, but I thought it was worth talking about at the AGM and just sort of explaining, and it's not an unusual chart. So what's a fairly typical life cycle for a one project company, and we're a multi-project company, but for one project company is that when you're in the exploration phase, what you tend to find is there's quite a deal of excitement and speculation about drill results, things you're finding, how big is it, and on it goes. And you tend to get quite a spurt in your stock price. And then as the company moves to the next phase where they have to knuckle down, do the very detailed feasibility work, a lot of internal studies, there's an element of what I call boredom. There's less news flow simply because we're working internally, not so much externally. So there's been 12 months of feasibility work that we've been working very hard on, which doesn't necessarily excite our marketplace as much. But that's not unusual. That happens in many companies. So what you tend to find is a little bit of a flattening in your stock price performance. And then when you get to that level, the value argument starts to dominate, and you tend to see the value of a company or an asset from a market perspective run up again. And so I suppose the point of this slide is to say we feel we're somewhere in that bottom dip at the moment. And given the value argument, I think people will start to understand that as we move forward. Next slide, please. Another way of looking at that and thinking about the company is that we've just announced our feasibility study at 125 million. I've touched upon the value enhancements, which is circa $35 million on a conservative basis. And the asset I haven't really talked about at all today is Bhutan, which I'll come to in the next slide. And we're currently capitalised at circa $0.06 per share. So that's the point about the previous slide. You're in the dip, but people forget what you've got in your portfolio. And we very much have a portfolio that in time people will recognise its value. So leading to the next slide. Some of you may have seen this slide before, but it's just worth talking about it a little bit again. BKM has a global resource of about 400,000 tonnes of contained copper, of which we're planning at the base case project to exploit about 175 or 172 to 175,000 tonnes base case, and it's just moved through the feasibility stage. Bhutan is still in detailed evaluation, but it's roughly 6 times bigger than BKM. If you just contemplate that, most of the value for the stock is attributed to BKM in a minute. And then sitting behind that are those sort of 15 odd targets that I've just touched upon very briefly KSK contract of work. So what's unusual about this company is that, for a relatively small company, it has a very large portfolio of assets. It's not a single asset company. So when Tony put the company together, when it merged with Kalimantan Gold, that was the objective, to put together a proper portfolio of assets and work through them systematically. So we still have that, and people shouldn't forget that. Next slide, please, James. So just wrapping up, and then we'll open up to questions, and I'll let other people talk instead of me. What are we looking at moving forward? So the way we see it is that the next steps at KSK is working through those detailed opportunities, which I've touched upon today. We'll then, in parallel with that, hopefully do a little bit of exploration on those 4 targets that I've also touched on briefly. That then allows us to fold that information in with the feasibility work to move to detailed engineering. So there's a series of quite definitive steps we've got to work through. It's at that point you look at the development funding piece, not before. And just touching on that, and we'll perhaps expand upon this a bit in discussions, but as you know, we've said quite openly we are talking to a number of potential strategic partners with the view to get their involvement in the project, in addition to which we're looking at traditional financing, off-take financing, and sort of other non-restrictive financing pieces. But there are definitive steps, so there's a couple of little steps, then the biggest step, I think, is what people need to keep in the back of their mind. In that same time period through to probably Q2 of next year, one of the things that we feel that could add quite a bit of value or understanding to Butong is metallurgical test work in relation to Butong. So Butong is a very large resource, 2.4 million tonnes of copper, 2 million ounces of gold, 20 million ounces of silver, and it's only drilled down to about 560 vertical metres. So we suspect it does extend to depth, but the top 120 odd vertical metres is oxidised. So what does that mean? It's possibly amenable to heap leaching. So we need to do that test work to evaluate whether or not that's the case. So that's sort of our work program for the next 6 to 8 months. Next slide, please, Joe. So I think, look, just in closing, and then obviously open it up to questions, hopefully you've got a flavour. We do have a quality asset portfolio, a very strong team of people who have done this before. Hopefully you understand the value argument. With respect to the copper market, we think it's exquisite timing, and I think that's a testament to putting the company together 4 years ago. You've got to sort of start your run with the expectation of hitting the market at the right time. And I think with that I might close and perhaps open for questions, and we can expand on anything I scooted over or want to ask about.
Thanks, Peter. And look, we'll open up for questions. I think there's just a couple of things that I would like to just add to what Peter said. Maybe, James, we can just flick back to the slide, which is continue back. There's a couple of things, really. Go forward a little bit. Next one. So this one here. So there's a couple of things, because I want to address the question that people said, what's difference from the PEA to the BFS in terms of the numbers. So there's a couple of things just really from an informative perspective. So number one is that when you do a PEA, the level of accuracy on a PEA, it's a relatively short conceptual study, takes in the order of 3 to 4 months, and essentially uses international databases of projects, costs, etc., to basically come up with a rough number. Does it make sense to take this project forward or not? The level of accuracy around that is plus or minus 50%. When you get to feasibility stage, the level of accuracy is plus or minus 15%. There's obviously an enormous amount of work, detailed work goes into that. And I was just thinking, when Peter put the map up with the mine plan earlier on, maybe just flick to that for a second, James. it's really easy. Next one back. Yeah, you look at this and you think, oh yeah, nice little plan, and got a few squiggly lines on there, and it's got ARD, sediment pond, water treatment plant, and all these things, all nice. Every single piece of that has a detailed engineering piece around it, design piece, cost piece, everything. And that simple little diagram with lots of squiggly lines is where all the money's gone to actually come up with the feasibility study in terms of the design, the pit design, the placement of each of those pieces of infrastructure, the materials types, and a detailed level of costing where you've actually gone out to suppliers to give you costs on these things. It's not taken off databases. So there's a very, very large differential in terms of the level of detail and accuracy in a BFS versus a PEA. Just flick forward, James. Next one, please. Yeah. The other differential between the PEA and the BFS is that in a PEA you can use your entire resource. You don't have any restrictions around using high confidence measured and indicated resources to convert to proven and probable ore reserves. You can use the whole of your resource to come up with a mining inventory. You'll notice that when we put the B for BFS out, that was preceded by a resource update, a reserve for the first ore reserve, and that ore reserve can only take the measured and indicated part of the resources to convert into the mine plan. The PEA actually includes everything. It includes the whole of the mineral inventory. You can't take the whole of the mineral inventory into your mine plan until you've drilled it up in sufficient detail that it can be carried forward. Now, if we were to go and drill up the entire lot we've got here, we would have needed another $5 million on top of what we've already spent. And given where we are as a company, we have done sufficient work to get the project to this point, but obviously once you press the button to go ahead, you're going to go and drill up those inferred resources and add to the mine plan. Which brings me to this diagram here, in that, and Peter alluded to this, you sort of see you ramp up your production, you're up pretty decent production, then it starts to drop off. Conversion of that inferred material that's currently sitting outside the mine plan, plus additional material that we may be able to pull in from BK South and West and any other things around. The idea is to fill this up here and continue this out further. And that there translates into a lot of value in discounted cash flows and NPV for the project. So I thought it was just worth sort of running people through that, so there's a little bit of better understanding in terms of that how those things compare.
How much does that infer can fill up the profile to the end of the 9 years? Or do you need to find more to fill up the profile to the end of the 9 years?
Good question. Very good question. We would expect that if you look at the differential, how many tonnes have we gone through to?
So our inferred resources at the moment account for about 30% of the overall global resource, of which we've included 7%. 7% of the inferred is included.
Yeah.
So 23% is excluded.
Yeah. So in answer to your question, we would think that 1 to 2 years of converting that additional inferred material, and then anything beyond that we'll have to add additional stuff. Yeah.
So as I said in the presentation, it's not an unusual chart to see in a feasibility study because you, as Tony said, you'll attempt to fill that as you're operating.
And probably the other thing just worth mentioning, there was a couple of things which were left out of the PEA, which they're fairly significant in terms of the overall capital cost, and those things were a water treatment plant, so a water polishing plant. So ultimately what happens with a mine site like this, as Pete alluded to, it's quite a wet site. So all the drainage water is actually collected. You just don't let it run off into the natural environment. You collect it all, and then that water, you've got collection ponds. You can see.
So everyone might be able to make it.
Yeah.
The water treatment plant is in the sort of centre left there.
Yeah.
So it says environment. Sorry.
It's just here. So water treatment, environmental control. So it's all the rainfall and runoff is encapsulated ultimately there.
And then that treatment plant, then you put the water through that treatment plant, which takes out all the heavy metals, treats it for, reduces sort of anything that's in that water that's over and above natural levels would get extracted before that water is released. So that was a pretty large piece, and you can never really estimate what that's going to look like until you've got all the base information collected in terms of rainfall, how much water, what sort of volumes you've got to treat, etc., etc. So that was an area that was not picked up particularly well in the PEA, and is a fairly significant cost item. It's somewhere in the order of $10 million. And the other one was the mine closure obligation. And the mine closure obligation is, and what that essentially does is that you have to allocate a certain amount of money in this feasibility study after year 9 to close the mine and rehabilitate everything, and that's $32 million. Now the reality is that obviously impacts upon the valuation of the ultimate net present value of the project, but the reality is each year that you add additional production pushes that further out, and therefore the value of that, the time value of that $32 million gets significantly less. But we have to include it for a study, for a BFS. You have to include a mine closure plan and allow for it upfront on day one. So there's a couple of pretty significant items. You're talking sort of in the order of $42 million of additional capital that's upfront. So I thought it was just worth a couple of things here.
As far as I understand, the mine closure costs allocated are conservative and slightly higher due to account for potential expansion of the mine into other areas as well. Is that right? With exploration upside?
Yeah, well, there's a couple of things in respect of that, and chip in, guys, if you want to. But number one is the mine closure costs are essentially for the 1,000 hectares, or 1,100. What is it, James? 1,200.
That's about
1,000.
Yeah, 1,000 hectare area that we've allocated for the mine development. So anything outside of that wouldn't be included, but that number, it's a holistic number based upon requirements, Indonesian regulatory requirements. So you may not necessarily spend that amount of money to get to that rehabilitation, which is the point that you're making, but it's a number that you have to set aside under in a regulatory sense, that the government fixes how much you need to set aside per hectare of disturbance. It may cost you 15 or 20 million, but ultimately you've got to set that much aside.
Can you just give some background on the Albion process? And you've said minimum 20 million enhancement. What is your more higher? How high do you think it could go?
So just a bit on the philosophy. And we went over this reasonably quickly, but just reminding everyone that the global resource at BKM is just a little over 400,000 tonnes of contained copper. And as we've illustrated in the presentation, we're currently planning to exploit circa 170,000 tonnes. So very rough numbers, a third. So by definition, there's 2/3 that we're not exploiting. And the reason for that is that the process flow sheet that we've done all this evaluation work on is an SXEW, solvent extraction electrowinning process, which works on oxidised copper mineral ore types or copper species. It doesn't work very well on sulfidic species. The Albion process is a process that considers effectively treating that some of that sulfidic material effectively by oxidising it. I won't get overly technical, but by oxidising it, such that you can then extract the copper metal. So we feel that it's something worth addressing. We haven't done enough work yet to know whether or not it will or won't work, but it's something you've definitely got to think about now, such that when you move to detailed engineering, do you think about including that, or do you say no, let's exclude that? Does that explain? Yeah.
Yeah, just on that, I mean, there's a lot of resource there that's not being captured at the moment. So that's really what that assessment of that aims to try and do. That's probably, if you can crack that nut, that's a big value piece. The second real big value piece is the piece that I just talked about. I mean, every year of additional mine life will add, how much, James?
Well, it's hard to say. It'd be, depends on millions of
Yeah, but I suppose at peak production, there's 90 odd million in 92, isn't it? Free cash.
Correct.
Yeah, so at peak production, it's about 92. So if you can fill your year up, you can do the maths quickly, right? And so the other alternative, which Tony's alluding to, is we find non-sulfidic ore types, so those 4 targets that sit around, we probably go to them first.
Yeah, so I mean, when you've got a relatively short mine life, the discounted cash flows are actually still very, very valuable today. So for every additional mine life, I mean, I can't put my finger on a number, but it's in the order of tens of millions of dollars of additional value to the MPV. So if we can add 2 or 3 years of mine life, it has a really significant impact on the project, and also fundamentally helps you a lot in terms of project financing, because project financiers typically look at a 5-year debt repayment schedule, and the longer the tail on the back end of that debt repayment schedule, the better they view the project. So there's a lot of benefits in additional, getting additional tonnage into the mine plan. Obviously, you need funding to do that, and we've always had to make decisions around where we spent the capital that we had available. It'd be nice to have $20 million and go and drill everything quickly now, but we've just, I guess we have to think through where's the best value proposition at any given point in time. And as I say, you've got to crawl before you walk, you've got to walk before you run, and we've got to make those decisions constantly about allocation of capital, and nothing's changed. We're still got to do that.
If I might jump
There you
in,
go.
Tony, I think one of the things that you could also reflect on is 12 months ago, what was the risk profile of the business in relation to the study? Everyone was still very optimistic around where things were at with the PEA, but with the release of the BFS, you can see that now we have very solid numbers sitting behind all aspects of the business. So in part, a lot of that news flow has been internal as we've worked through the studies over the last 12 months, but the business is now being de-risked by, we've got a great deal of confidence. Plus minus 15% is a heck of a lot better than plus minus 50%. And it is that pathway forward. The value opportunities are also clearly identified to be able to improve things going forward. So it hasn't been as sexy over the last 12 months, but it's when hard work has had to be done, and that's the platform for going forward. Early on, Peter was talking about the time that it takes to bring on copper projects. And I was just jotting down a few of the things that really mess around with the risk profile. Grade we touched on, but the geometallurgy, ore bodies are getting more complex. The easy ore bodies across all minerals are generally being processed. There are small parts of deposits that are nice and sweet, but more often you're actually finding that you've got a lot of smaller deposits that you aggregate into a project. And you can see we've got another 15 targets that are going to be able to be converted to some extent, but more work's required. In terms of the capital costs, the closure costs, and the environmental requirements globally are going up, and sadly the mining industry has never had a good history of doing things, and our own PEA also highlighted that there was some rushed approach to get some numbers out to the market. But with what we've done in this study is we've brought everything back in and we've engineered things where we may have gone a little over the top, but that again will get reviewed in the value engineering stage. But we are able to address and meet not only the current expectations of stakeholders, which is also the local community, and you've always got to make sure that you do address your neighbours in this equation. But by being able to put forward a process that is most likely going to be able to meet future requirements, which get more stringent, you've got more confidence in coming into the project. And as one of the new directors, what was it that attracted me to coming on to the board here? One was knowing the management team, so quality of people, but the quality of the exploration. You've got to have the fuel in the tank to drive the business. And from a geological and metallurgical perspective, it was all quite solid, something that I could actually feel quite confident. I'm putting some of my brand up by getting involved with the company, and happy to do so when going through the technicals and engaging with the team. So as we progress the business and we de-risk it, you can see it may not always be sexy, but at least it's going to be reliable. And it does take time. And when you've got to allocate your capital conservatively, you've got to make those calls where you do it, but you've got to make sure you get bang for your buck. And I think Peter and the team have been able to deliver that over the last 12 months.
Yeah, and maybe just to close that sort of out a bit, we did have a delay in the delivery of the BFS. It took us another 6 months. Just a couple of things around that. So typically, the path of a project from PEA is not directly to BFS. So typically, the path is PEA to a pre-feasibility study, and then from a pre-feasibility study, you narrow down your options and you take the preferred option forward into a feasibility study. Given that we're a junior company, resources are limited, timeframes are important, we actually compressed that timeline. We took a calculated risk in doing that and went straight from a PEA to the BFS. And there were some things that came out of doing the work that dictated that we had to go back and do some more detailed work around the geotechnical engineering work and drill up some more of the deposit in terms of the confidence levels and also the geometries. I can honestly tell you that 6 months of additional work has made a massive improvement to the project. We could not have been at this point now without that work having been done, because without it, the consultants were taking very conservative views of things and layering on lots of additional cost based around conservatism, which was actually really hurting the project, which we knew, given your background and experience, that it wasn't real. It was actually just layered on costs because, at the end of the day, consultants, they're signing off on the study. So they will take the most conservative sort of angle given the data they got available. So by providing them with heaps of additional data of the drilling and that we've done, it's really improved the quality of the study, the confidence of the study, and the outcomes of the study. So, people get a little impatient with these things. Yes, you've extended it 6 months. Why has it taken so long? But ultimately, it's in the best interest of all stakeholders to actually do that, because the outcome we've got now is solid. We can have some sensible discussions with, financiers, both debt and equity, and we've actually got a project that is plus or minus 15%. It's a real project that we can take forward. We could have rushed out something that was substandard, and to be quite frank, there's a tendency for junior companies to do that. And then, there's a lot of backfilling goes on from that point onwards. We didn't want to take that approach because we genuinely want to take this project through and into development. So from our perspective, we needed to do that work to de-risk it to the point that we're at today. So, you can get criticised for these things, but ultimately I think people will realise that it's in the best interest of all stakeholders to have done what we did.
The potential partners you're discussing, have they realised that and recognised that in the discussion you've been having since release?
Oh, absolutely, because there's another thing. There's been a lot of chatter around. Well, you've been talking about this partner and that for a long time. It's only natural that a person that's going to invest in this project is going to wait till the feasibility study's done, right? So yes, we've had a lot of discussions. We've had a number of groups sign CAs. We've had a number of groups do diligence. We've had a number of groups visit site, and those that are genuinely interested to sort of progress discussions further, get to a point and say, well, we'll just wait and see when the feasibility study gets delivered. So the robustness of that feasibility study, these people are using, some of the, some top industry consultants to scrutinise our feasibility study. And like I said to Peter, one of the groups has used one of the guys that I use to actually assess copper leaching projects worldwide, and they've actually pulled him in. And I said, well, if that guy, and I won't say his name, but if he's ticked off on it, then I feel pretty good about our project, right? It absolutely, that absolutely gives a much more robust set of numbers and project and technical work and stuff for people to do their diligence on. So, we're in now, obviously, as you would expect, it's been out. We've obviously got to give those parties a little bit of time to digest what's there, go through it. But, the follow-up to this week is to start to circle back with those parties and
Any new names emerged since the BFS? That details on?
Yeah, it's at the moment there's the existing parties. I will say that with the introduction of ASIPAC, a bigger interest from ASIPAC, we're actually just translating all our presentation materials and stuff into Mandarin at the moment, and they have a number of parties who are interested to have a look at the project and the data that they've introduced to us, and we'll be doing that over the next little while. Look, I can honestly tell you here today, I'd like it to happen tomorrow myself, but these things are particularly in an Asian context, and Dom can speak to this, having worked in Asia most of his career. There's a lot of circling and there's a lot of dancing to be done, but we're reinvigorating all of that sort of in the coming, as of sort of next week with the current group, plus also we'll expand that to a wider audience, because not just for BKM, but also thinking about partnering for Bhutan.
Would you say that the recent raise would see you through the value enhancing stage to the point where hopefully funding will come on board?
I think sort of just picking up, I'm not ducking the question, but just picking up on the comment, what we need to get a good feeling of is that these counterparties that we're talking to, where are they at? Because if they want to participate earlier rather than later, and we don't dictate their timeline, it allows us to work through both the opportunities and the detailed engineering steps more aggressively, depending on your demand. So I think as Tony just said, we've got to work through that step literally in the next couple of weeks and work out, where they're at. Do they need more time? Are they satisfied with what they've got? And Dom made a very interesting point, and Tony was alluding to it. When you get your feasibility study out, by definition, you de-risk the asset a bit more. So if you're a potential counterparty coming in, however you want to come in, you're much more comfortable once that bit of information is checked off, right? So I think we need to work on that bit.
Yeah. I mean, we've always got funding requirements. We're a junior development company, and we're always constrained by, by the amount of capital you've got available. There's just so many things that you could do if you had capital. So I think the first port of call is our preference would be to introduce someone now. If that doesn't happen, then we'll just have to reassess. Well, if there's no more questions, thanks everybody for. We have got one more.
Permitting on Baroi. Permitting on Baroi.
Baroi. Yeah, so just a couple of things on Baroi. Obviously you can see from the discussion today that while we love the look of Baroi as a project and opportunity and can generate some exciting short-term news, it's the best thing that we can do with the money that we've got available is add life here at the moment. It's going to have an immediate impact to the base case for the project. So number one is about allocation of capital. The second thing is that Baroi, James, can you just go to that? Baroi is in a different forestry classification to
It's that map, James.
the map.
Just go back up. Keep going.
Yeah, there we go. Yeah, so Baroi, you can see, sits in a different area. So it's about 20 kilometres away from 25k. It's in a straight line.
Okay.
We have good access into the BK area. Baroi is actually more difficult access. So when Baroi was drilled previously, it was drilled with helicopter support. So if you add helicopter support to the cost of drilling, it's pretty expensive. So from our perspective, it's as much as we'd love to do it now. If we had unlimited resources, we would be doing it now. We have to put it down the priorities list. The second piece is that it's actually in a different forestry classification. So we're in production forest over in this area here, where open pit and underground mining are allowed. Over there, that's in what they call protection forest, and protection forest only underground mining is allowed. And it's actually much more difficult to get a permit to do the work in that area. So we've got applications in with the forestry department to get access to do exploration in that area. But to be quite honest, we haven't prioritised pushing those permits. We've got a whole range of permits that we need to get for BK and BKZ, and that's really where our priority's been lying. So we can go and push this and push it really hard and get it, and the expectation is that we're going to be doing the work tomorrow, spending serious money on it. That's the expectation. Right? Now, the government rightly, says, well, we've given you the permit, we've given you everything you need, why aren't you doing the work, right? And saying you haven't got money to a government's not a good answer. You're there as a foreign investor and you're expected to invest. So, behind the scenes in all these things, there's sort of strategic decisions that have got to be made, and where you prioritise your time, your money, and just the interface with a whole range of different stakeholders, not just shareholders. That's a single lens. There's a much bigger lens that we have to sort of consider in all the decisions that we make.
Just regarding Asiamet, do we know who the board member's going to be? It hasn't been obviously announced yet.
Yeah, well, look, we're not. It's just, unfortunately, we have to go through a process with the regulator to get approval for the person to come onto the board. Dom had to go through it as well. But obviously when Dom came on board, we did all that work in the background and then announced it, right? But because this was part of the financing, we had to announce it up front. But it generally takes 4 to 6 weeks, the process. So, we're not in a position to say who it is, just in case they don't get through the process. But, that's pretty advanced now. We'd expect to be able to announce that fairly shortly. And I will say, just on Asiamet, and I alluded to before, I've already been doing quite a bit of work with them on, identifying parties, and as it goes in Chinese business culture, I've already been out eating and drinking and getting to know different people, and there'll be plenty more of that. People think it's a good fun life going out, eating and drinking every night, but I can assure you it's extremely tiring. But it's very necessary. Okay, well, I think with that, thanks everybody for attending. It's really appreciated coming along. And I think we've got a cup of tea and a bicky. Yeah. So feel free to have that, and then interface with, as Peter said, James, our CFO, is here as well. Put your hand up, James. Yeah. So if anyone wants to ask any questions of any of us, feel free to do so. Thank you.
Thanks, everyone.